I see it coming. So welcome to our webinar this afternoon with on life science investors. Is the faucet still on? And we're going to be talking with investors about, what are they doing now? What are they seeing? And also what can companies do to prepare for when life gets somewhat back to normal. So I will, with that, and just as an FYI, we'll be doing more of these. We have a couple more that are in the works that will get scheduled and announced here really soon. So keep an eye out for our emails. And with that, I will turn it over to Bob Crutchfield, who is our moderator today.
Hey, thank you, Jason. And boy, it's a real pleasure to serve as moderator for this panel. Good panels are generally comprised of a good topic and great panelists, and I think we have both today. So what I'd like to do as we get started is to have the panelists introduce themselves, give a little background on themselves, the firms they work with, and their firm's thesis from an investment perspective. So Kip, we'll start with you, go to Gerry, and then to Joe.
Sure. Hi, everybody. Kip Sirinakis, co-founder, managing partner of Epidarex Capital. We are a seed and early stage exclusive life science venture firm. Been around since 2010, and on our third fund, we primarily invest in startups, either that we start from ourselves or out of universities, and really work, or company builders. We really work to kind of start very early on in the process. We do both therapeutics and devices. Dabble a little bit in diagnostics and health IT, but our bread and butter are therapeutics and devices. I've been a VC since the late 90s. I've, fortunately or unfortunately these days, I have navigated through 2 down cycles. This will be my third. So I look forward to the conversation.
Cool, thank you, Kip. So welcome everybody, delighted to be here. Hope everybody is doing okay. I'm Gerry Brunk, I'm a managing director at Lumira Ventures. I'm based in Boston. Lumira is a Canadian and US venture firm. It's been around about 25 years. I joined the firm in 2002. So like Kip, have as a venture investor and an entrepreneur been through a couple of these types of disruptions. Nothing quite like this one, but helping our companies navigate through that. Myself and my partners have certainly been through, a couple of these in the past. We also invest in biotechnology and medical devices, occasionally diagnostics and digital health companies. Today we're managing about 400 million of capital, about halfway invested through our most recent fund. So we are still very actively investing. Our strategy has always very much been focused on backing innovative teams, companies developing innovative products that might fall outside the traditional hubs of innovation in North America, like Boston and San Francisco. And over the past 20 years, the Southeast has been one of those primary areas of focus for us where we've generated our best returns. So happy to be with you guys today and hand it over to Joe.
Great, thanks. I'll add my thanks and welcome to everybody. Thanks for participating in this panel. My name is Joe Cook. I'm a co-founder and managing director at Mountain Group Partners in Nashville, Tennessee. Our sector focus is life sciences, ag tech, and healthcare tech. Within life sciences, it's diagnostics, biotech, and med tech as well. So we invest early stage. We do some seed investing as well. We look across the entire United States. We love to be as close to home as possible, but really follow where the executive talents reside and the teams that we want to work with. Last year, we closed on an $83 million fund. We're about half invested out of that, and currently particularly excited about a lot of that are things that are happening in the personalized medicine space, both diagnostic and therapeutic, but also in home. So as we broaden the definition of even what life sciences entail, I think we're going to be talking about some of that today, but those are key investment thesis for us.
Hey, well, thanks for that. I've had the privilege of interacting on opportunities directly and indirectly with you all, and I want to really affirm and validate to the folks that are listening that you're 3 of the best life sciences investors in the country, and so it's pretty exciting to have the opportunity to talk to you about what's going on with this COVID-19 pandemic. You know, it's an interesting time because the pandemic is a health event. The economic crisis that's going to follow this is going to be painful, but it's not because of the economy being poor. It's before the pandemic, but because of the results of unemployment, a lot of things that are going on. You know, so as you guys with active portfolios are looking at your companies today, how is the coronavirus impacting your portfolio companies? Because most of them are life sciences or med tech. And then also, you know, what is this doing to your own current business operations as fund managers? So Kip, I'll start with you, and I'd like for everybody to answer this question because it's really an important question to many of these folks who are listening in.
Sure. So it's really been an interesting time. I mean, we've been fortunate that a number of our companies just recently raised cash. So they are still kind of moving forward. However, in some cases, their clinical trials actually have been put on hold. So, you know, we've been looking then at making sure that there is still funding to ensure that when things ease up, that they're able to get back going. So with that, obviously, you know, working with our companies to ensure that that they need to make cuts, or if they need to, you know, kind of work with people and there's salaries and other things that they're doing. So they're looking at it, they're considering it. Some of our companies that are working actually are at an interesting stage because some of the university labs have shut down. I think probably for those companies that we're out fundraising for, we've had some interesting times where, for instance, one of our companies was a day away from signing a term sheet for a Series B, a quite substantial $75 million Series B. Syndicate actually put the term sheet on hold, and we had to negotiate. Thankfully, we came back and were able to do a slightly smaller round, same syndicate. But interestingly, the valuation did change. We had a nice healthy uptick beforehand. Still have a good uptick, but it did come down because certainly the syndicate was concerned about how the end had been able to create value in the post-pandemic world. I think there are challenges, but you know, I think most of the CEOs are navigating well, and I think that's really a key is for that you're using the cash you have wisely, and you can to work with or your current investors even to make sure that that your balance sheet. Was there a second part to the question? Sorry.
Yeah, so the second part of the question is, and I'm going to come back with some follow-up questions too, but the second part of the question is, you know, how is this impacting your operations as well? And I think, you know, everyone makes capital calls as they're doing deals. And so if you've got committed capital during a moment of, you know, sort of market fluctuation like we're seeing now, you're sort of sitting in an advantaged position because valuations will certainly be a little more volatile as we're coming out of this. But do you worry at all, and we talked a little bit about this on Friday in the prep call, but do you worry at all about, you know, your LPs sort of not being able to make the capital calls and you having, you know, issues with, you know, raising capital to be able to continue funding for a fund that you've already raised?
Yeah, so we're going, you know, we're continuing to look at deals. So we expect capital calls are coming here in the next several weeks for different deals that we're working on. We are fortunate to have, I think, a pretty stable group of partners, mostly institutional investors or so. I think we're okay from an LP default.
Yeah.
My funds that I've been involved with, thankfully, we've not had an LP default during any of the hard times. mostly because I think, you know, they plan for these things, they've allocated, they do this long-term commitment. And the terms on defaulting are actually quite draconian, so they find a way to take care of that. That said, though, we are putting, we're talking to several banks to put some, look at whether we need to put a, to enhance our fund line of credit to just
Yeah.
kind of there to take care of some timing issues. And so, you know, that's still ongoing just to make sure we get our business. But I think the biggest thing that we're seeing is the syndicates are still coming together, but it's taking longer to get together on new deals versus deals that have already been in discussion and in diligence.
Yeah. Gerry, how about you guys? Your portfolio companies, how are they doing?
Yeah, Bob.
And operationally for you?
Yeah, I mean they're generally doing well. You know, clearly, starting about 5 weeks ago, we started to work closely with our teams around, first and foremost, you know, making sure that their employees were safe and that their clinician partners were safe and their patients were tended to, whether they were in the middle of a clinical trial or whether they were commercial stage companies where they needed to support procedures. So that was really step one. You know, we quickly evolved, as Kip said, to thinking through cash management and, you know, what the implications of really a kind of an unknowable duration of this disruption might be on companies. That's really the biggest challenge. So we've generally held back making really draconian cuts. You know, the companies, clearly there are some relief efforts coming into play, which have some marginal benefit, I think, for our early stage companies, not the intended target necessarily, but you know, there are some opportunities there. And then it really divides out into the stage of companies. So preclinical, clinical, or revenue stage. For the preclinical companies, you know, there are some major disruptions around animal testing, GLP work, and that has a day-to-day delay, obviously, on those companies trying to get into clinical trials or file for an IND, and it's really out of our hands. So again, focused on safety and taking the advice of CDC and FDA. For clinical stage companies, it gets a little more complicated, of course, because you've got studies that are in process. We've seen an absolute disruption, as I'm sure everybody has, in terms of sites coming online and enrollment for anything other than, you know, the most serious acute medical needs. So anything elected clearly is put on hold. We're advising our companies that, you know, enrolling clinical studies of that sort probably, you know, really won't be coming back online until October or November of this year. Hopefully it starts sooner, but we're beginning to look out that far, quite frankly. And then the other challenge is patient follow-up for studies that are already midway completed, but that have 6 or 12-month checkpoints. How do you ensure the integrity of data? You know, a lot of discussions with the FDA around how they'll, you know, take data for approval trials or even phase 1 trials during this time. So that's something we've been reaching out to outside consultants on with our companies. And then clearly commercial stage companies, you know, if they're medical technology companies with a capital expenditure element, hospital budgets, not surprisingly, are going to be effectively frozen and put in a pretty challenging position, frankly, for the next couple of years. You know, their most profitable service lines are exactly those elective procedures, which was speaking over the weekend to a health system CEO who questioned whether when we return to some normalcy, you know, patients who are maybe otherwise would have come in for a hip replacement say, you know what, I'll stick out the pain because I really don't want to go to a hospital for the next year or two with the risk of, you know, so these are some long-term challenges, I think, for commercial stage companies. Fortunately, we've got a couple of telehealth and remote monitoring companies, and, you know, we do expect them to be poised extremely well for some structural changes, both reimbursement and adoption coming out of this. And then quickly on the fund management side, like Kip, you know, most of our LPs are institutional. We do have a number of family office investors. You know, clearly back in 2008, that was a bigger concern, LP defaults, because there were fundamental credit and liquidity challenges in the economy globally. You know, we don't have that yet here, and hopefully we won't have that. So our LPs have been, you know, very open, and if anything, have even approached us over the past couple of weeks about, you know, the concept of accelerating fundraising for a new fund, because I think everybody realizes very often that you know, the best returns often do come from periods of challenge and disruption. When you just look at fund returns from, you know, coming out of the 2008 crisis, this clearly is different because it's a health crisis. But you know, we're not seeing anything that would challenge our ability to continue to support entrepreneurs either in our current fund or in new investments going forward. But there will be a little bit of a pause as we all sort out, you know, the next few weeks, what the future looks like.
Yeah. Hey, Joe, so same question to you. You're a little different, I think, in terms of your structure, but would love to hear the answers to the same questions.
Sure. To start with our LPs, we've communicated with our LPs and reached out, and don't see any problem. I mean, all of our LPs are high net worth individual family offices, and they often have more cash, frankly, than they know where to invest to get good returns. And so they see this, like Gerry, a little bit as a, is there anything we can do to increase our stake even though we're closed, or can we accelerate? Can we do a co-invest? So I think there's an increasing appetite to opportunistically lean into this. Where that's important, though, is on the investments where we are in sectors or in stages that will be least likely to be impacted. What Gerry talked about, I think, is very important. The hospital sector, I think, is going to be particularly hit hard and will take a long time to recover from this. The lack of the elective surgeries and the mix across the different revenue streams is really profound. We've talked to a lot of hospital chains that are cutting executive pays by as much as half, physicians' pays by a quarter. And they're also sending letters out to medtech companies, large medtech suppliers, saying, we're going to pay you 70% of what we previously were paying summarily. It doesn't matter what our contract is. So they're seeing a tsunami of financial strain. So anything that goes into the hospital system as a decision point or a payer, I think is going to be slow to return. Now, ultimately, innovation will lead the way out of that box, because you need to innovate to have better outcomes and lower costs. But the time frame of getting the attention in the midst of a crisis lengthens. So we looked across the portfolio of not only the health of our co-investors, but the ultimate customers or takeout partners. And we're working with management to shift the timelines to be either realistic or resources towards those that will capitalize on that. So think about at-home testing, think about diagnostic things that are elective procedures that can be moved out, or even procedures you don't need because you have a diagnostic test that can preclude the need for a procedure. All those things we think will be accelerated, and we're leaning into that from that standpoint. But in the near term, you know, runway extension is the name of the game. We're in the midst of the stay-at-home shutdown, and so we don't even know how to quantify the costs or when the restart happens. So Gerry mentioned Q4. I would say we're hoping for a return to some doctor office visits late Q2, but clinical studies and ramping back up, I think, is at the tail end of the year.
Hey, and you know, with that comment in mind, you know, I don't know how many of your financings are tranched. You know, we used to see a number of early preclinical biotech companies tranched on milestones of performance. How does that work, do you think, today, right? As your clinical trial processes are disrupted, time horizons extend, milestones won't be met. You think that they're going to be, you know, restructuring of the terms on some of these deals? And are you getting questions from entrepreneurs about this already, or is it just too early? That's for all of you.
Yeah, I can take a cut at that. I mean, it's both. I think the venture investors, as well as for companies that have venture debt, you know, a particular consideration, because, you know, clearly venture debt providers have a different, you know, credit risk profile. So we have anecdotally heard about some liquidity challenges, you know, coming in from pre-negotiated tranched deals for debt. Again, like Joe said, kind of too early in the process around the equity side of things. Looking back to 2012 2002 and 2008, 2009, we didn't see a lot of that across our syndicates. There may be certain types of syndicate members who are more challenged and maybe think differentially about their ability to kind of come in. Hopefully, that's a small percentage. We have, over the past 3 weeks, seen a couple of the corporate venture arms hint at pulling back a little bit because of the uncertainty they have with their own balance sheets. But nothing that's really kind of hit the fan yet, as it were. But we're, again, staying very close to all of our syndicates and all of our co-investors, to feel that out.
Yeah.
Yeah, I think what we've seen actually, and people are starting to think about this as they did in the other kind of downturns, is really now. Just in case things take longer, the milestones may not get met, but the fundamentals of the business are still good. The milestones aren't necessarily met because of the situation globally, not necessarily anything that the company did. So we're spending a lot of time internally and talking to our co-investors about making sure there's plenty of money on the table to withstand.
Yeah.
Right. I do think going forward, though, we'll think, as we would always, about identifying core key milestones along the way and funding to those. And that's just good investing anyway, but I think it'll be less maybe resisted either by some syndicate partners that have really large funds that like to write big checks early, that we find ourselves structuring argument a little bit, or a CEO or management team that wants to have all the cash up front. I think the realistic is it's often prudent for both sides to set the milestones, fund to those, and then make sure you have sufficient reserves that you're able to fund into that as success begets and people want to invest. But that's kind of a fundamental part of early stage venture investing anyway, at least for those of us who've been around. It's easy to write big checks and like everything the first time, but it's the second and third checks where you tend to make your returns and shift capital appropriately.
Hey, so this is a really good setup to sort of shift now and try to think from the entrepreneur's position. So if you were an entrepreneur today at a point where you're trying to go into the market to raise funds, what do they need to be doing and thinking about in terms of maybe altering their decks or thinking about things a little differently in terms of metrics, or approaching VCs at this time? Impact on the coronavirus in terms of valuation. So what should they be thinking about as they approach the market? Joe, we'll start with you this time.
Sure. I mean, I think the biggest thing is, depending on the stage we talk about, it's very different. But if you're entering into a disease space that is, the patient is less apt to feel the impact of the disease, I think they're less likely to want to return to the doctor office visits or enroll in studies. So take diabetes or other metabolic disease. I think those patients historically have been hard to enroll anyway. I think it will be harder to enroll. But if you take an oncology study, or if you take even psoriasis or something where patients feel the disease, they are seeking treatments more actively. And so you almost have to look all the way down into the specifics of the disease, the motivation of the patients themselves. But then also, I mentioned the hospital or the setting where the studies are going to happen on the clinical side, I think is really, really important. So there's a realistic, you're going to have to add a little realism into this from a budgeting perspective, and having slower enrollment, more cushions, more defined milestones along the way. And I think it's going to take longer to raise money. We've talked about that, but I think that's just prudent. So what you may want to do is break things up into more bite-sized milestones, or do smaller tranches along the way, or find other creative ways to augment the cash flow, whether that's in terms of how you bring on people or that. So that would be one. The other is, I think it's really important that these entrepreneurs don't use analogs pre-COVID-19 to argue about valuations and structures, because it is a different world. And we often hear people come in and reference a deal that they've read about a year or two ago. And it's an interesting data point, but at the end of the day, if we're interested and we have available cash, the market's going to price things and structure them. and it'd be better to get a round closed and try to optimize on terms and be able to see whether or not there's legs on this idea.
Yeah. Gerry, how about you? Additional comments?
Yeah, I mean, advice I'd give to an entrepreneur, I guess, first of all, is if your business or your innovation, you know, truly can play a role post-COVID, as we're all saying here, then obviously you should highlight that. But I would also caution people going the other direction, because I've gotten quite a few business plans over the past 3 weeks where, you know, COVID-19 is now kind of the headline part of the story, where 4 weeks ago probably wouldn't have been. So it's become a little bit the new cannabis or Bitcoin or blockchain, I guess, of business plan titles. And I just caution people to go, you know, not to go overboard, because, you know, we're all skeptical to start with here. But if there is a real implication, and there are some businesses, quite frankly, that we have begun to relook at, which we may have passed on 6 months ago or a year ago, where we do think structurally the fundamentals of the healthcare system, you know, are much more supportive of those businesses now than they had been. The other thing we're spending a lot more time on, and we spent a lot of time on it already, challenges around federal health systems, state health plans, regional hospitals, and insurers. You know, I don't even think we're close to comprehending what that's really going to look like. I mean, obviously we're adding several $1 trillion to kind of the federal deficit here. States are going to suffer, and local municipalities that run hospitals are going to suffer in a way that, again, we don't yet comprehend. That's going to have an implication for what types of healthcare solutions are going to be paid for. You know, we've got loss of tax revenue, we've got loss of sales tax, income tax revenue. So again, we're just focused, I think, a lot more on solutions that are going to be so transformative in terms of the patient benefit and their ability to reduce overall healthcare costs than we've really ever been before.
Kip, additional thoughts from your side?
No, I mean, I think Joe and Gerry covered most of my thoughts. You know, I know that we are continuing to look at new deals. We're continuing to due diligence. You know, things may be taking longer. I think, you know, we've not yet made an internal decision actually to know whether we will close a deal that we've not actually met the entrepreneurs in person yet. We will close that deal time frame. So I think entrepreneurs should be prepared for the fact that this may take longer, and you know, you may not get a deal closed from an institutional investor going forward until we can kind of come out of this, since relationships are just so important. And so with that, actually, a good time, even if you're not raising money, to kind of continue to work on and shore up and talk to your kind of the VCs that you may be raising money from later, and build those relationships, give them updates, make sure you take time to do all that, kind of some of that same blocking and tackling that you've always done. It might be even more important now to kind of make sure you're doing that.
Yeah, we used to always joke that the #1 job of the CEO is to raise money. So always keep raising money, particularly now. You know, you guys have all mentioned that as a function of the coronavirus and the pandemic, that investment theses may be shifting a little bit in terms of the opportunities you're looking to invest in. You know, as you look at the landscape today and you're starting to think about what are those companies and types of companies that have the greatest chance for success, you know, post coronavirus, you know, what would you, you know, sort of elevate those sectors as? So Joe, you mentioned a couple of things on the call, on call notes last Friday. So I'll let you start, and then we'll go to Kip and then to Gerry.
Sure. I think the obvious is vaccines, and there's that's a tough space though. So I'll leave that as an interesting space. But I think that the diagnostic testing space in general is interesting to us, but I think it's going to become more interesting as a societal public health from a what capacity and what technologies do we want to have on the ready for either other pandemics or other infectious disease, and where should they reside? And do we want to burden our healthcare system with the testing and the treatment of those that are sick, or do we want to separate those? So I think there's a huge amount in the diagnostic testing arena that's of particular interest to us. Also look at telehealth, which is obvious. I think the regulatory changes that have occurred to allow cross-state border telehealth is going to be really hard to put back in the box. That's been something we've all been talking about, but there have been some legislative and some political lobbying reasons why. But now that that's open, I'm not so sure I know why we would go back, nor should we. And so that opens up a whole new way of treating patients, doing follow-up. You may still have initial visits on site, but a lot of the follow-up visits don't actually need to be done then in the healthcare facility, so that increases capacity. Telehealth, and then there's this remote patient monitoring and engagement, both in the hospital but in other settings. This isolation, I think, is opened up people's awareness of the need to be connected, both from a health outcomes, but just for a mental health perspective. We're not as active in that, but we're looking for technologies to partner in with some other investments that we have, that there's a patient monitoring, patient connectedness overlay to the broadening of the way healthcare is delivered outside of this one-to-one in-person setting. So those are some of the big investment thesis areas. But another thing I guess I'll mention also is it's interesting, we actually have several animal health technologies that are applicable in the human health space, and we're seeing an increased interest in that because a lot of the early work has been done. And while we're pursuing both animal health commercial applications, we're actually accelerating some of the human health at the same time out of the same companies. And heretofore, those have been kind of hard to get funded. You almost had to set up two companies to go after it, even with the same technology.
Hey, just one follow-up question. As you know, I think telehealth will work with providers from outside of the state, provided that there's a continuity of workflows and data that link back to that primary care provider that sort of, you know, owns that patient or has responsibility for that patient. Are you thinking about it that way as well, as more than just the telehealth play itself, but it's the technologies that allow telehealth to be an integrated care model?
Yeah, absolutely. In fact, I mean, I think the first step will be the Vanderbilts of the world that only have locations in Tennessee but see patients in Alabama and Kentucky will still maintain and own those patient records, but the patients won't have to drive 2 and 3 hours just to do their follow-up visits. So to me, that's the low-hanging fruit. That's not even getting the full benefit of telehealth, but that's an immediate just patient follow-up, the cost of that patient to take the day of work off and all the things on top of that. So at a minimum, yes. Longer term, we do have this health data repository and transferability and mining that is still not quite where it needs to be. That this might be a drive for that. I think that may be a little bit more aspirational than I expect to come out of this, but I do think just the patient follow-up and some of the legislative changes are likely here to stay.
Yeah, Kip, any differences in what you see?
Yeah, I mean, for us, since we're doing early, I think on some of the med tech, we're starting to talk it out and look for things that aren't going to play catch up. So, you know, there's a lot of things in the telehealth space that have kind of been in the works, and maybe we're kind of waiting for the market to get there. And so I think the market has now come. And so we're now thinking about how do we think about where the extensions are, where the legs are, where, if you will, the bowling pins are, that foundation. How is that going to affect how people work, how the system works, and thinking about that next thing. You know, we are big on step change. I mean, more than step change, we like really very innovative changes. So, for instance, on our med tech strategy, we are primarily PMA and de novo 510K kind of technologies, And so thinking about how that is going to, opportunities that could be appropriate for that next generation, now that the market is, I think, coming or is about there. So it's really kind of thinking for that kind of faster, better, cheaper, what's going to make it all sing. I think there is plays and things like that that might actually now come to fruition. We've been talking a lot about AI and data and all that.
Yeah.
So maybe now there's a time to kind of see where that can really be leveraged on the medtech side.
Hey, Jerry, before Jason cuts us off and brings in questions, the one question I wanted to ask you, particularly since you guys have some telehealth deals, you know, one of the things we've seen as a function of the virus is that there are certain outliers that have comorbidities, polychronic, you know, conditions that are at higher risk. And do you see a movement with telehealth to concentrate? You know, chronic care management has been a, you know, sort of a lumpy play, right? It's worked some, but it hasn't worked effectively and at scale. So that predictable, repeatable, scalable business model hasn't fully developed. Do you think this might be that moment where, you know, chronic care management becomes something a little more than chronic care management, where patients are managed, treated, and guided in a slightly different way than before, and telehealth becomes more and more of a play there?
Yeah, we do, Bob. And kind of to Joe's point, I think a lot of this is a genie that is never going to go back into the bottle. And it's not too hard now to look forward 5 years from now, 10 years from now, to a world where the technologies enable better remote monitoring, but also the payment systems appreciate and reward actually doing that. And we still haven't quite been there yet. I mean, you talk about complex chronic care management, there are some relatively new CMS codes that you know, provide a little bit of an add-on for that, but it's still been a challenge getting clinical practices to adopt many of these things. You know, now, again, not too big of a stretch to say, well, why wouldn't all of us, even those who are kind of generally otherwise healthy, pay or have paid for some type of ongoing, you know, consistent, reproducible, clinically validated monitoring of our health condition? And that can range everything from wearables to implantables to, you know, so that's kind of what we're really excited about, right? Is what does that world look like? Again, we've got a couple of companies living that right now, one in the heart failure remote monitoring space to keep people out of the hospital and modulate their medicines ahead of a heart failure admission, and then another in the ambulatory arrhythmia monitoring field. But it's actually pretty exciting now as those companies, because they've got a little bit of time on their hands now, they're not running clinical studies, is to think about what does that future look like, and what are the policy changes that have to come about, what are the payment system changes that have to come about. But it you know, it feels like the world's going to be pretty exciting going forward here.
Thanks. So Jason, you're disrupting my party, but go ahead.
Yeah, I did get a question actually from Facebook, so thank those that are on Facebook right now. And also anybody in Zoom, you can use the chat function there at the bottom if you'd like to ask a question, and I'll be following along. So we did get a question about companies that are looking for expansion capitals to launch a product. Any advice for companies like that now, particularly? That could be for any of you.
Well, you know, it's I guess my first reaction is wait a few weeks before launching a new product. You know, it is going to be pretty impossible to get, you know, time and attention. But from a risk point of view, if you've got a product that's you know, that's already approved and poised to go to market, I think Skip said having those discussions with investors in real time, you know, probably does make a lot of sense. But you've got to be very realistic about what your launch plans might have looked like 5 weeks ago, you know, been fundamentally changed, and unfortunately probably changed to the negative in most of the cases, sometimes maybe positive. So factor all that into your projections and how much capital you think you need.
In the ultimate end market, we talked about, are you going to a hospital or a nursing home, or is there another setting? Who's paying for this? Is it existing code? Is it new? I mean, there's so many variables that would have to factor into that. But as Gerry said, I mean, this is not an easy time, particularly this week. In a month from now, we may be in a much better place where we can start quantifying and mapping out the rate that we're expecting things to return, and we can assess how much capacity people have for anything new. Anything new and different right now is being deprioritized in most elements in the healthcare system, regardless, both patients and the whole system. So introducing anything new right now is going to be at a disadvantage to just maintaining something currently. And so that's where, if you're launching a new product, I think you just have to be realistic in that right now, but that will change. And if it's truly transformational, there will be uptake and interest, but it's hard to know how long it will take before that returns to where people even hear, both from an investing but a customer perspective.
And I, depending on if you're targeting kind of non-critical healthcare sectors right now, in the sense of, you know, elective or other areas, it might be a good time actually to think about different business models. Maybe you need to find some KOLs that you can actually engage and try to get them to, if they're still able to be doing some practice of their you know, do some things for free even, you know, give the thing away just to get some people using the product early on, if they're in fact still actively seeing patients or that. But so think creatively about how you can adjust your launch strategy. You know, there's a lot of venture money out there. There's a lot of money for growth stage companies. So I would not be discouraged in going and talking to people if you need to raise money.
And the only thing I would add to the comments is that, you know, expansion capital for growth, if you have a product or a product line that is going to be focused on more critical elective procedures or more critical, you know, current, you know, sort of needs in the marketplace, raising expansion capital for growth is probably, if you have current customers, you have an opportunity to expand your customer base, is probably easier than raising expansion capital for new product development.
Yep.
Jason, we seem to have lost you for a second.
No, it's, I think that I just got a text that answered the question. So I think we're good to go there, and don't have any other questions right now, but I'll let you know. Good.
Well, you know, the last sort of thing that I would ask you guys is, as you look at, you know, it's funny, Gerry, you said earlier, in sort of a very, you know, easy way that, you know, several $1 trillion in relief will be coming into the market. You know, I mean, that's like several $1 trillion. That's a very big number. Do you guys have portfolio companies today asking you to assist them with how they get access to some of these dollars? Are your firms looking at access to some of these dollars? And do we believe that those dollars coming in are going to be enough to create, you know, sort of a shorter U-shaped recovery as opposed to a longer L recovery?
Well, a couple of thoughts. I mean, one, as a matter of public policy obligation around who the intended beneficiaries of these relief efforts really were, and those were really largely small businesses and large employers. You know, for better or for worse, our portfolio companies are neither large businesses and they're not big employers either, right? I mean, we've got companies doing a couple of phase 3 programs right now, and they've got 7 employees.
Yeah.
So it is a debatable question whether those are the intended, and backed by a strong syndicate of financial investors like us, who, you know, theoretically should be able to see them through, you know, a 2-month, 3-month, 4-month disruption here. Having said that, these are also companies driving tremendous innovation at a time when the healthcare system needs a lot of innovation going on. So, you know, the notion of having to furlough staff, lay off staff, terminate clinical studies, you know, clearly is not a public good either. So, so we definitely have companies that are doing the small business loan program. The affiliation rules around venture funds making a lot of those companies ineligible, is still getting sorted through. Looks like it's largely been dealt with. But I think what we are finding is that there are, many of these programs really are, were not intended to help our types of companies, and our companies may not be, entirely eligible for them anyway.
Yeah, it's interesting because, if to me, the intention of the dollars are to keep the economy moving and to keep people employed, particularly people who are doing, everything from, restaurant workers to people who are scientists working on big projects. So, so that's interesting to me. And, early stage companies, this becomes sort of like non-dilutive capital for them. So it's beneficial to the entrepreneurs, it's beneficial to the management teams, the employees, as well as the VCs. So I think if there are ways to gain access to that capital, I think it could actually help get us an early stage company. We're talking about extending time horizons and those kind of things. If they buy an extra 4 months, it's a big deal. So so it'll be interesting to see how many of the VC companies get back.
Yeah, well, we definitely have some companies that have already made it through the process. Doing the loan last week, and clearly getting $2 to $3 million at 2-year money on 1% interest that's forgivable at the end of that is it's a hard thing to turn down.
Yeah.
Sorry, Jeff.
Yeah, we're definitely encouraging our companies to apply. I think the purpose of the bill is also partly to defer what otherwise might be decisions that you would make very proactively to try to get ahead of extending the runway. And so to some extent, deferring for 60 days the hiring or furloughing decisions is actually exactly what this bill wants. So a lot of our companies with clinical studies, or you can't call on doctor offices anymore in the commercial stage, any of those things, right now everybody's still on payroll under the expectation we qualify for the loans in by 60 days, and hopefully we'll start to see some return to normalcy. So I think we're expecting most of our companies to not only apply, but get approved, and I think we'll have some benefit. You asked the question, is it enough? Probably not, but I don't think that should necessarily be the purpose of the program, was to be fully offsetting as much as provide a little bit of a base or a backstop in the midst of the chaos, so we don't have this cascading unemployment scenario, not unlike the market sell-off that was all program trading for a few days. There was no decision-making happening. That was just all systematic selling. We wouldn't want that same thing in the employment base to happen. And so I think that's going to be the benefit of that program.
Yeah. Jason, additional questions?
Yes, we do. We have two. I'll start with this one because it's about the $2 billion Senate bill that was recently approved that Amy Klobuchar supported, that will provide dollar for dollar match funding for startups in the Southeast and Southwest, previously underserved regions. Will that cause you to invest more in startups in the Southeast?
I mean, we actively, so we're based in Bethesda, Maryland, not quite Southeast, but we actively look and participate and like to invest outside of the hubs, so similar to Gerry. And so I think, that is something that certainly will be a boost for the Southeast if it goes through, and hopefully we'll be able to keep some entrepreneurs that are kind of developing interesting technologies to kind of be able to keep propelling them forward. So absolutely on our radar, and would be great if it went through.
Great.
Yeah, I would agree that it's going to create also additional funding for groups that have traditionally had difficult time finding money. So I think women-owned and diversity-owned businesses, I think are going to be great beneficiaries to this program from the Klobuchar model. As long as they make it fairly simple to access, because it's a matching program, and those are, you know, really great non-dilutive dollars, and everybody likes those.
Yeah, yeah.
Great.
One more question, focus to bring down into the seed stage. You know, what advice do you have for recommendations of startups to be able to get capital or new products or research that are in the earlier stage?
From some sense, I think the earliest stage companies may be least impacted, partly because their burn hasn't gotten to a level that they're having to access more institutional capital. So you have more friends and family, have more grant dollars and programs. I actually expect to see an continued increase in NIH funding out of this. I think people's appreciation for science and medicine and healthcare technology is probably elevated as a whole society. And so out of that will flow political wins. Those programs tend to benefit earlier stage, seed stage companies and the inventors right off the bat. There's a capital gap from that development dollars that goes into the more company formation that I don't think will be addressed by that. So that's the gap that I think is probably strained the most. But the early stage, I actually think this could be a real helpful environmental change in people's appreciation and interest.
Yeah, and I think to just follow up on that, I think to get through that capital gap, even if you really need to, in the early stages, make sure that whatever you're developing, the translational aspect of it is stronger than ever, because so few capital already in that capital gap. You know, companies like us, we see a lot of interesting technologies, can only fund a few of them. But that's where really making sure that you use the grant dollars and stretch them, and also that the translational part of it, there is a commercial aspect to what you're doing, I think is really important.
Yeah, the other thing I would add to that is that while the dollars may, the grant money, you really have to work hard to figure out how to write the grants well. So entrepreneurs need to be thinking about that. And this is also, and you mentioned this earlier, Kip, when you're taking seed money from family and friends, what you really need to bolster that are good scientific advisory board members, good, business advisory board members, so that you're able to make that, use those dollars very efficiently, drive as far as you can to and through inflection points, so that it makes that funding gap that Joe was talking about a little easier to close.
And just as a quick follow-up, I think someone mentioned it before, really be realistic about valuation, because the game has changed. I'm an advisor to a university fund, and somebody has a SaaS product, and they still think they can get valuations at 5x and on pilots, and we're like, yeah, no, you couldn't get that even a month ago. You're not going to get it now. So just really think about how the whole landscape has changed, and be realistic, because at the end of the day, the last thing a seed stage investor wants to take money from, traditional, sometimes individuals that maybe are overvaluing the company. You're going to get a down round when you get institutional investors. So be smart about your calculators.
Yeah.
Right.
And I would add, Bob, I mean, and Jason, for entrepreneurs, we have this session here maybe comes across as a little pessimistic because we're all in the middle of this right now. But I'd actually be pretty excited as an early stage entrepreneur now, because I don't think anything structurally is going to change with the flow of capital to funds like ours, and even family offices and high net worth individuals who, although maybe temporarily their assets have taken a beating in the public equity markets. I think that universe probably is a little more in tune to backing healthcare innovation going forward. And I think funds like ours generally, our LPs, if anything, may be redirecting more capital over the next 3 to 4 years than they might otherwise have thought to deploy, because healthcare as a public category, public equity category, is held up obviously better than consumer goods and technology, traditional IT. So I don't think, and this is very different than 2008, right, where I think many of our firms did a fundamental shift to late stage investing. And a lot of early stage firms simply went away because the LP capital wasn't there to support that next follow-on fund. I don't get the sense that's what we're going to be looking at. So as an entrepreneur, again, I hope that's encouraging to all of you out there, you know, in terms of your ability to get even early stage capital during, you know, what still seems like some dark days, you know, ahead of us in the short term here.
Great. And Dennis, who asked the question, this is actually going to be the topic for one of our next webinars, is alternative funding, and we'll have somebody from the NIH on there. So, and then one more, we have about, you know, a minute and a half. How about strategics? What's your perspective on their thinking at this point?
Well, I can start. I alluded earlier in the discussion, you know, we do have one company that's got a financing coming together right now, and unfortunately there were, you know, a handful of strategics. There are already 2 strategics invested in the company. There were a couple of others who, you know, literally over the past few days have pulled away because their boards of directors have basically put a total halt on CapEx and investing activity other than anything to support, you know, the near term maintenance of margins and cash flow. So that probably corrects itself, but it is certainly a dynamic that we're seeing in real time. But don't expect to persist, you know, uniformly, hopefully towards the end of the year.
Yeah, the flip side to that is we've seen within the last week or 10 days, actually, a couple of term sheets coming over for M&A, actually. So, you know, some of the corporates have good, strong balance sheets, and it's a really good opportunity, a good time now to be picking up some companies as well. So I think it's case by case. Never shy away from strategics, though.
All right. Well, thank you all very much. I really appreciate it. Thank you for your time. And I know everybody's crazy busy, even though we're all at home. And appreciate those that joined and those on Facebook, and have a great day.
Hey, Jason, you just got a question.
Thank you, guys.
Whether the video is going to be.
Oh, yes. Yeah, we record this, so I'll get this onto YouTube. I'll post it on our Facebook page, but then I'll also get it up on our website. So
Thanks, everybody.
Thank
Thanks
you.
all.
Everyone,
Great. Thank you, guys.
Stay safe.
Bye-bye.
Take care.
Bye.